I got the question from a business owner, should I file an extension for my taxes? And I love this question because I actually personally file our business returns every year through an extension. And the number one reason that I do it is because from February to say April 15th, the tax team and tax preparers are so busy. You just simply say, hey, don't worry, just file an extension for me. It gives 6 months to be able to find the most ideal time. I've even heard of some tax preparers, they'll discount their fee if you say file for an extension. I don't know how often that's the case or not, but I do know it can be a major weight off the shoulders, and then they can fit in, like, here's gonna be the best time I can give full attention and time to the return to make sure it gets done very well. So that's one reason I do it. Now, you have the business and the personal return. Business return is due on March 15th, personal return is due on April 15th. And it's important to know that because you still have to have your extension filed by those dates. Something else that you gotta make sure you understand, just because you're filing extension doesn't mean that the payment deadline isn't still April 15th. And what that means is if you make your quarterly estimates, what you know is like, hey, I'm still gonna owe a little bit of money, you're still supposed to pay that extra money by April 15th. And I'm gonna show you how that breaks down. The other thing is there's other costs to wait too. There's some interest costs that the IRS will charge if you owe them money. All right, so here's how it breaks down. I just made an example. First thing I wanna note, we avoided the failure to file penalty. And why is that important? Is because there's really 3 different expenses that the IRS can charge you if you file the extension, but you still owe the IRS money. So you have interest, failure to pay, an estimated tax underpayment. And here's how it would break down. So let's just say in 2024, you had $20,000 of taxes owed to the IRS. And in 2025, you said, you know what? I think we're gonna make about the same amount of money. I'm gonna make estimated payments of $20,000. In that particular case, there's no interest, no failure to pay, or no estimated underpayment. But you find out after filing for the extension and then preparing your taxes that you didn't actually owe $20,000, you owed $30,000. So what's gonna happen with that $10,000 that you already owe? So obviously you gotta pay the $10,000, and I'm gonna make, in this case, the example, if you wait all the way to 6 months. So basically you're taking a $10,000 loan from the IRS for 6 months. How does the IRS charge you? First off, you have interest, and the IRS, that interest rate can fluctuate. I'm gonna say on common average is maybe about 8%. So say if it's 8% at the time, that's $400 because it's 6 months and $10,000. And then you also have a failure to pay. This failure to pay is what the IRS does to incentivize you to say, hey, you probably should know if you're gonna owe $10,000, so try to get this number close. So the failure to pay might be about $300. Now, if I'm gonna look at this financially and percentage base wise, I'm saying, okay, I had $700 that I had to pay for the interest charged, the cost of that $10,000. If I look at that at 6 months and I wanna annualize that number, then that goes from 7% to 14%. So all right, I know that I have a 14% loss on these dollars. How does that compare to my other interest rates? I don't know, but at least I know in this particular case. Now, I also gave a 6-month example. In my previously stated purpose of filing an extension, you could simply wait until, say, May 1st or May 15th or something. If it's only 1 month, then you're only paying 1 month of interest, 1 month of failure to pay. Now, I do want to cover how it works when it comes to the estimated tax underpayment and what that means. In the example, say in 2024, you had $20,000 that you owed and paid, and now it's 2025, but you paid nothing. That's where that comes in. And you paid nothing, but you owe $30,000. So what would happen is that $30,000, now you're paying interest on it, you're paying failure to pay on it, and you're paying the estimated tax underpayment. So you have 3 charges. So that $30,000, and it could be over the course of, say, 18 months, because it didn't pay anything January 1st all the way up until October 15th. Now you're looking at maybe from 14% to maybe 20%. So the failure to pay, it does have a little bit of variability on the timing and different variables, but you are now looking at 3 different ones. So the way it kind of breaks down is do the best job you can to pay what's owed on the April 15th, give your tax preparer some time, can make a big advantage for both you and whoever's working with their taxes to get them done and take some weight off their shoulders.